No more taxes on Social Security. That's what Trump promised during the 2024 campaign. And millions of retirees thought, finally, the money I already earned, already paid into, and already waited decades for. But here's what actually happened. What's up, everyone? If you're over 65 or have parents who are, you need to watch this entire video. Because on July 4th, 2025, Congress passed something called the One Big Beautiful Bill Act, or OBBBA for short. And no, it didn't eliminate Social Security taxes completely, but what it did do is actually more interesting and honestly, more useful for most seniors. Accountants noticed it immediately, and if you're not paying attention, you could be leaving thousands of dollars on the table. Let me break it down in plain English. What actually happened? Here's the first thing you need to know. Without this bill, the 2017 tax cuts were about to expire at the end of 2025. That would have meant higher tax rates, smaller deductions, and a surprise tax increase starting in 2026, including for retirees. Congress stopped that. The lower tax brackets are now permanent. The standard deduction is permanent. That alone prevented a massive tax hike for millions of seniors. But that wasn't the real story. On top of keeping those old rules in place, Congress added something brand new, a $6,000 extra deduction just for seniors. And this is where the math on your tax return completely changes. The new deduction explained. Starting in tax year 2025, that's the return you'll file in 2026. Anyone age 65 or older can claim an extra $6,000 deduction per person. Married couple, both over 65, that's $12,000 on top of your regular standard deduction. Let me show you what this means in real numbers. Before this law, single senior, $16,950 of income protected from tax. Married couple, $33,100 protected. After this law, single senior, $23,750 protected. That's $6,800 more. Married couple, both over 65, $46,700 protected. That's $13,600 more. You're not getting one deduction, you're getting 3 layers stacked together. The regular standard deduction, the extra amount for being over 65, and this new $6,000 senior bonus. And when you stack them all together, nearly $24,000 of your income becomes completely invisible to the IRS if you're single. Nearly $47,000 if you're married. Why this matters for Social Security? Now here's where this gets really interesting. Under the old system, the IRS had tripwires. Once your income crossed certain levels, they didn't just tax your pension or IRA withdrawals, they went after your Social Security too. Here's how it worked. For married couples, income under $32,000, Social Security not taxed. $32,000 to $44,000, up to 50% of benefits taxed. Over $44,000, up to 85% taxed. For single filers, those lines are $25,000 and $34,000. Those thresholds never changed. They're still the same today. But here's what did change, how easy it is to stay below them. With this new deduction, your taxable income drops. When taxable income drops, your provisional income drops. And when provisional income drops far enough, Social Security slides out of the taxable zone entirely. The result? About 88% of seniors receiving Social Security are now expected to owe zero in federal tax on those benefits. Before this change, that number was only 64%.
The hidden catch. But hold on, because there's a trade-off nobody's talking about. The government giveth, and the government taketh away. For years, many low-income seniors were automatically enrolled in Medicare savings programs. These programs helped pay for Medicare Part B premiums, deductibles, and copays. No forms, no hassle, just automatic help. Under the new bill, that automatic enrollment was turned off. Now, your Medicare isn't being cut, your Medicare card is still safe, but that extra help layer, you now have to apply for it yourself and reapply and re-verify your eligibility every single year. Let me put numbers on this. Medicare Part B costs about $222 per month in 2026. That's $2,664 per year. If you qualified for help before and don't realize you need to reapply, that $222 gets deducted straight from your Social Security check. So if you're getting $1,800 a month from Social Security, you're suddenly living on $1,578 instead. Same expenses, same needs, just less money. Who wins and who doesn't? Here's the honest truth. This bill isn't designed for everyone equally. Very low-income seniors, you probably weren't paying much federal tax anyway, so there's not much to reduce. Wealthy retirees, at higher income levels, this deduction starts to phase out. The real winners? Middle-income seniors. People over 65 who have Social Security plus a small pension, maybe some part-time income, maybe withdrawals from a traditional IRA, total household income between $40,000 and $120,000. For these households, this new deduction can save $1,200 to $2,000 per year. That's $100 to $160 staying in your pocket every month. It's not a raise on paper, but it feels like one in real life. A lot of seniors are calling this a silent raise. Nothing flashy, just more breathing room. The expiration date. Now here's the detail almost everyone misses. Some parts of this bill are permanent. Lower tax brackets, permanent. Standard deduction structure, permanent. Estate tax thresholds, extended. But that extra $6,000 senior deduction, it expires after 2028. Unless Congress steps in and extends it, you've got a 3-year window. 2025, 2026, 2027, 2028. That's it. This creates an opportunity, but also a ticking clock. The Roth Conversion Opportunity. And this is where things get strategic. This law doesn't mention Roth conversions in big bold letters, but it makes them far more powerful for the right seniors. Let me explain how this works. Traditional IRA. You didn't pay taxes when money went in. It grew tax-free. But when you take it out, the IRS taxes every dollar. Plus, at a certain age, you're forced to take money out whether you need it or not. Roth IRA. You pay the tax first. After that, the money grows tax-free and comes out tax-free. No required withdrawals, ever. Roth Conversion. Moving money from a traditional IRA to a Roth IRA. Normally, when you convert, the IRS says that counts as income this year, and you get hit with taxes. But here's what changed. Because your deductions are higher now, many seniors have income space they didn't have before. Space where income can be recognized without crossing into higher tax brackets, making Social Security taxable, triggering higher Medicare premiums.
Let me show you how this works with a real example. Meet Blake and Beia, a married couple, both over 65. Their situation: total income, $72,000, half from Social Security, half from pension and IRA withdrawals. After deductions, including the new $12,000 senior deduction, taxable income, $23,700. Now here's what's powerful. For married couples, the 10% tax bracket goes up to $24,800. So Blake and Beia are sitting entirely in the lowest tax bracket. They have $12,000 sitting in a traditional IRA. If they wait, future withdrawals will be fully taxable. Instead, they convert $12,000 to a Roth IRA this year. The senior deduction acts like a buffer. It absorbs the conversion before it creates a federal tax bill. The income was reported. The IRS saw it. The math just never got high enough to trigger tax. Now that $12,000 is in a Roth where it grows tax-free, it comes out tax-free, it never forces withdrawals later. They're essentially building a tax-free inheritance while the sale on tax rates is still active. The phase-out trap. But there's a catch in the fine print. This extra senior deduction doesn't last forever if your income gets too high. For married couples, deductions start shrinking at $150,000 of income. For every dollar above $150,000, you lose 6 cents of the deduction. At $250,000, the deduction is gone completely. This is where a strategy called QCDs becomes really powerful. QCD equals Qualified Charitable Distribution. Instead of withdrawing money from your IRA, which counts as income, you tell your IRA custodian to send money directly to a charity. That money never shows up as income on your tax return. It's like it never existed. This lets you stay below the $150,000 phase-out line, keep your full $12,000 senior deduction, avoid IRMAA charges, high-income Medicare penalties that can nearly double your Part B premiums. One move, 3 benefits. The bottom line. Here's what this all means. The OBBBA gave seniors a tax break carrot, but it's waving a massive administrative stick right behind it. You're now the manager of your own survival. The government isn't coming to save you with automatic anything anymore. It's a trade-off. More cash in your pocket, more paperwork on your desk. You have until 2028 to ride this tax-free wave before the senior deduction expires, which means right now, you're not just a retiree, you're a full-time financial strategist in a high-stakes game of don't forget the forms. If this video helped you understand what's actually happening with your taxes, smash that like button and subscribe so you don't miss the next one. And if you want to see how a simple $5 a day investment can grow into a portfolio paying over $8,000 a month in dividend income, check out the video I've linked in the description. Thanks for watching, and I'll see you in the next one.